Learning objectives. After completing this digital module, learners will be able to understand that the role the government plays has several implications for its deficits, which further affect its debt. Learn that the government provides certain goods and services which cannot be provided by the market mechanism. Learn that when goods are produced directly by the government, it is called public production. Learn how the government sector affects the personal disposable income of household by making transfers and collecting taxes. Learn that as the wages and prices do not fall below a level and thus the employment cannot be brought back to the earlier level automatically. Understand that the intervention of the government, whether to expand demand or reduce it, constitutes its stabilization function. Learn that redistribution objective is sought to be achieved through progressive income taxation, in which, with income rising, the tax rates gets increased too. Understand that when government takes fresh loans, it will mean that in future these loans will have to be returned and interest will have to be paid on these loans. Learn that the budget documents classify total expenditure into plan and non-plan expenditure. Understand that the fiscal policy strategy statement sets the priorities of the government in the fiscal area, examining current policies and justifying any deviation in important fiscal measures. Understand that when a government spends more than it collects by way of revenue, it incurs a budget deficit. Learn that when the government incurs a revenue deficit, it implies that the government is using up the savings of the other sectors of the economy to finance a part of its consumption expenditure. Learn that the capital receipts created by the non-debts are those receipts which are not borrowings and therefore do not give rise to debt. Understand that the goal of measuring primary deficit is to focus on present fiscal imbalances. Learn that the increase in government spending directly affects the total spending, whereas taxes enter the multiplier process through their impact on disposable income as to influence the household consumption. Learn that during a recession, when the GDP falls, disposable income falls less sharply, but the consumption does not drop because of the tax liability as it is fixed on the other hand. Learn that how by borrowing, the government transfers the burden of reduced consumption on future generations. Understand the situation when some private borrowers will have to leave the financial markets as the government claims an increasing share of the economy's total savings. Government budget, scope and objectives. Promoting welfare in the name of public expenditure and imposing taxes for costs to earn the revenue. These two opposite sides need to be balanced as the utility and disutility of the government financial transactions. Thus, we may say that the budget document is a reflection of government's expectation for future. When expenditure and revenue gets unbalanced, we can see the surplus or deficit budgets. In brief, it consists of plans, programs, projects for current and as well as the proposals for coming year, details of resources and income from different sources, the depiction of actual receipts and expenditure of previous year, and various government agencies, financial performance and its relevant data. Allocation and redistribution functions of the government budget. We know that government provides public goods like streets, national defense, and else which are not the properties of any private individual. Moreover, the properties of the public goods are non-excludable, where we can find many non-paying users. Thus, the goods which are financed through the budget and can be used without any direct payment, they are called public provisions. The public goods can be made under private ownership or directly by the government in public production system. Sometime, through imposing taxes, government tries to change the distribution of income towards the needy section of the society by the aid of different welfare activities, which is called the redistribution function. Stabilization function of the government budget. The spending tendency of numerous private economic agents affect the level of aggregate demand, and this is directly proportional with the level of classification of receipts and expenditure. Revenue receipts and capital receipts of the government budget. For the revenue receipts, the liabilities or assets have not been created. These types of proceedings of taxes, rate of interest or dividend on any government bond or securities, cess or any other receipts for the services as provided by the government. They are the current income receipts from various sources and shown as the means of government expenditure. The capital receipts are the outcomes of creating liabilities or borrowing and reducing assets or disinvestment. That is why the raising of funds by the government by incurring a liability or by disposing of some assets are entitled as capital assets. In the case of revenue receipts, government is not bound to return the amount in future, that is, they are non-redeemable. But the capital receipts are intrinsically borrowing, so they must be paid along with interest. Revenue expenditure of the government budget. Similarly, the revenue expenditure neither balanced, surplus and deficit budgets. Measures of government deficit, revenue, fiscal and primary deficits. In revenue deficit, the budgeted revenue and expenditure figures are not equal to actual amount of revenue received and or the actual amount of expenditures. In revenue surplus, the actual amount of net income exceeds unlike the revenue deficit. At times, the government's total expenditure crosses the limit of the revenue as generated, but it excludes the money from borrowing, then fiscal deficit occurs. According to Keynes, the deficits helps progressively the countries to getting out from the economic recession. The requirement to borrow the money from the market for any government usually includes the interest obligations on the accumulated debt. Thus, by measuring primary deficit, it tries to focus on present fiscal imbalances. Fiscal policy, changes in government expenditure and taxes. By doing changes in the expenditures and taxes, government intends to increase output and income in the economy. When government takes the expansionary method, then the expenditure increases than the rate of taxes as imposed. It eventually results in better GDP and reduces unemployment. In contractionary approach, government increases the tax rates to reduce the inflation, which on the other side increases unemployment. Balanced budget multiplier, proportional taxes and transfer payments. In any balanced budget, The consequence of increasing government expenditure shows the balanced budget multiplier. The increase in government spending here equals by the increase in taxes in respective manner, which leads to increase in net income by the same amount. The proportional income tax can be acted as an automatic stabilizer in the economy as it increases the flows of disposable income and consumer spending. In economics, the transfer payments or government transfer shows the redistribution of income and accumulated wealth as done with goods or services during transaction. These payments are generally non-exhaustible as any resource are not directly absorbed here. Deficit and debt. Perspectives on the appropriate amount of government debt. When the government borrows, the burden of reduced consumption implicates the lives of future generations. Because the borrowed amount is to be paid off in future, and consequently, it may require to impose taxes as well. So the future generation eventually will feel the situation, where they will be compelled to consume less, and this will lead to decrease in national saving also. The Ricardian equivalence proposition is a sort of economic hypothesis where the consumers are considered as forward-looking and thus they could manage their consumption decisions at the time budget constraint of the government. Other perspectives on deficits and debt. When the private sector's saving is going to reduce, the rate of investment also decreases. That is probably while government goes to borrow from the individuals by issuing bonds to mitigate its deficit. Those bonds make the availability of the funds for other private bonds a little complicated. In this position, some private borrowers then opt to crowd out of the financial markets for the reason of government's claim of increasing share of the total savings in the economy. Deficit reduction. In India, the government tries its tax revenue mainly through aid of direct taxes, while the indirect taxes implicates all income groups equally. Through the sale of several public sector undertaking organizations, government endeavors to raise the receipts. Although reduction of government expenditure could be achieved through better planning and administration. The Fiscal Responsibility and Budget Management Act 2003 enacts the government function in order to restrain the fiscal deficit not more than 3% of GDP. Summary. Let us summarize what we have learned. The three functions of allocation, redistribution, and stabilization operate through the expenditure and receipts of the government. The government provides certain goods and services which cannot be provided by the market mechanism, as the wages and prices do not fall below a level, and thus the employment cannot be brought back to the earlier level automatically. The gross fiscal deficit is a key variable in judging the financial health of the public sector and the stability of the economy. The fiscal policy strategy statement sets the priorities of the government in the fiscal area, examining current policies and justifying any deviation in important fiscal measures. When the government incurs a revenue deficit, it implies that the government is using up the savings of the other sectors of the economy to finance a part of its consumption expenditure. The increase in government spending directly affects total spending, whereas taxes enter the multiplier process through their impact on disposable income as to influence the household consumption. The budget gives a statement of the receipts and expenditure of the government as divided into the revenue budget and capital budget to distinguish between current financial needs and investment in the country's capital stock. Proportional taxes reduce the autonomous expenditure multiplier because taxes reduce the marginal propensity to consume out of income. The public debt is burdensome if it reduces future growth in output. The enactment of the Fiscal Responsibility and Budget Management Act 2003 FRBMA in August 2003 marked a turning point in fiscal reforms, binding the government through an institutional framework to pursue a prudent fiscal policy. The GST is the biggest tax reform in the country since independence and was rolled out on the midnight of 30th June or 1st July 2017 during a special midnight session of the Parliament.